Welcome to Talk Tickers. Today we're doing a deep dive into something that, well, it quietly directs where trillions of investment dollars flow. It's all about tax.
It is. We're pulling back the curtain on the sophisticated engineering that gives exchange-traded funds ETFs a massive tax advantage over traditional mutual funds.
And we're not just talking about the basics. We're going into the hidden mechanics, specifically a maneuver called the heartbeat trade.
Exactly. We're going to show you how this all works and why it's fundamentally changing investor behavior across the globe.
Okay, so let's start at the beginning.
Yeah.
We have to unpack the core problem that ETFs were designed to fix. For anyone who has held a mutual fund in a taxable account, this is probably a familiar headache.
Oh, it's a huge headache. It all comes down to how mutual funds handle redemptions. When an investor wants their money back, they sell their shares back to the fund.
And the fund has to give them cash.
Right. And to get that cash, the fund manager often has to sell some of the fund's underlying stocks or bonds. Now, if those stocks have gone up in value,
Which you hope they have.
you hope they have, but selling them triggers a capital gain inside the fund.
And this is the part that feels so unfair. I could be a long-term holder, I haven't sold a thing, but suddenly I'm on the hook.
Precisely. That capital gain has to be distributed by law to all the remaining shareholders at the end of the year. So you get this unwelcome tax bill for a transaction you had absolutely nothing to do with.
You're essentially paying taxes on somebody else's decision to sell.
It's a negative tax externality. It's a huge structural flaw for anyone trying to defer taxes and let their money compound over the long term.
So if that's the problem with the old model, how does the ETF structure just completely bypass this taxable event?
The solution is, well, it's really elegant. It's all built around what's called in-kind creation and redemption.
In kind, so not cash.
Exactly. The fund itself almost never sells securities for cash to meet redemptions. It's more like an institutional bartering system.
Okay, walk us through that. There's a key player here, right? The authorized participant, or AP.
The AP. Yes, these are the big financial institutions, the market makers. Now remember, you as an investor, you trade ETF shares on the stock exchange just like a stock.
Right, with other investors.
But the APs deal directly with the ETF issuer to create or destroy large blocks of shares to keep the price in line with its value.
So let's say a lot of people are selling an ETF and the AP needs to redeem shares from the issuer. How does that work?
This is the magic. The AP doesn't get cash. Instead, they hand over a big block of ETF shares, and in return, the fund gives them a basket of the actual underlying stocks and bonds. It's a direct swap.
They're literally trading ETF shares for a handful of, say, Apple and Microsoft stock.
That's it. And the genius is in the tax code. Section 852 face of the U.S. Internal Revenue Code says that when a fund hands over appreciated shares in kind like this, it's not a taxable event for the fund.
So no capital gain is realized inside the ETF?
None. The tax liability isn't gone. It's just been pushed outside the fund onto the AP's books. And for the remaining EPF shareholders, nothing happened. No tax bill.
That's a game changer. And this applies not just to regular redemptions, but even when a fund has to rebalance its portfolio.
Yes, which is critical. And what's really fascinating is the power this gives you, the investor, the power of deferral.
Because the ETF almost never passes on a capital gain, you don't pay any tax until the day you actually decide to sell your own shares.
Correct. And that is like an interest-free loan from the government. All that money that would have gone to taxes stays invested, compounding year after year. It's massive.
And this leads to the ultimate tax benefit, the one you hear about for estate planning, the step up in basis.
That's the one. If you hold those ETF shares until you pass away and leave them to an heir, their cost basis gets stepped up to the market value on that date.
Meaning all those years, maybe decades of accumulated capital gains?
Wiped out, completely forgiven, permanently tax-free for the heir.
Wow. I mean, that explains why the data shows high net worth investors are piling into ETFs. Advisors for wealthy clients had nearly 47% of their assets in ETFs last year. That's way higher than, say, a pension fund that doesn't care about taxes.
And that trend really took off after 2012 when capital gains tax rates went up. It just made the tax deferral that much more valuable.
Okay, but what happens when an ETF manager needs to sell a lot of appreciated stock, maybe for a big rebalance? But there aren't enough natural redemptions from investors to use that in-kind mechanism.
Ah, now you're getting to the advanced course. This is especially true for higher turnover strategies like smart beta or active ETFs. They need a tool to force this tax cleansing process.
And this is where the heartbeat trade comes in.
This is the heartbeat trade. The name comes from what it looks like on a fund flow chart. You see this huge sudden spike up in assets. An inflow followed a day or two later by an equally massive spike down. An outflow, like a heartbeat on an EKG.
So it's completely manufactured, prearranged trade. It's not real investor activity.
Not at all. It's a choreographed dance between the ETF's portfolio manager, the PM, and an authorized participant. It's designed specifically to scrub the portfolio of taxable gains.
Okay, lay out the steps. How does this dance work?
So, step one, the AP creates a huge block of new ETF shares. This is the big inflow. They do this maybe a day or two before the fund is scheduled to rebalance its index.
And at the same time, the AP is probably shorting the stocks they know the ETF is about to get rid of.
You got it. They're setting up both sides of the trade. So now the ETF manager, the PM, knows for certain that a massive redemption is coming in a day or two from that same AP.
A guaranteed outflow.
A guaranteed predictable outflow. And that allows the PM to be incredibly strategic. They get to choose exactly which securities to put into the redemption basket that they'll hand back to the AP.
And they're going to choose the shares with the lowest cost basis. Let's break that down for a second. What does lowest cost basis actually mean?
It means the shares that have appreciated the most, the ones they bought years ago for cheap that are now worth a fortune. These are the stocks carrying the biggest embedded, unrealized capital gains.
The biggest tax time bombs in the portfolio.
Exactly. If the PM had to sell those on the open market, it would trigger a massive taxable distribution. Instead, they package up these specific shares and put them in the redemption basket.
And the final step is the AP redeeming their shares and getting that custom-built basket of high-gain stocks in kind.
And the loop is closed. The AP uses those stocks to cover their short positions. The ETF manager has successfully rebalanced the fund, gotten rid of their biggest tax liabilities, and done it all without creating a taxable event for you, the long-term shareholder.
That is just incredible financial engineering, and you can see it in the numbers.
Right.
The use of these trades has surged, right?
Right.
From under 4% of ETFs in the 90s to over 26% now.
It reflects the rise of more complex, high-turnover strategies that absolutely depend on this mechanism.
Which brings us to the big question. What's the catch? This can't be a free lunch. There has to be a cost to all this complexity.
No, it's not free. And you're right to be skeptical. Think about it. You have a massive pre-announced coordinated trade happening right around the market close on a rebalance day. What does that invite?
Front running. High-speed traders who see it coming and can trade against the fund, pushing the price up for the stocks the ETF has to buy and pushing the price down for the ones it has to sell.
Exactly. It creates information leakage. The result is called slippage. The ETF's performance slips just a little relative to the index it's supposed to be tracking.
And that can add up. I saw one example where the slippage cost was estimated at 6 basis points, or 0.06% of the fund's assets. For an active strategy that's supposed to be generating alpha, it could eat up a big chunk of it.
This is the crucial tension. On one hand, you have this massive quantifiable tax benefit. The tax alpha has been estimated to boost after-tax returns by an average of 1.05% per year compared to mutual funds.
1.05%. I mean, that's a staggering number. No wonder capital is flooding into these things.
It is. It's exactly why, since 2021, over 120 mutual funds representing more than $143 billion have literally converted their entire structure into an ETF. They're doing it specifically to give this tax benefit to their investors.
So investors are basically making a trade-off, whether they realize it or not. They're accepting a small, almost invisible performance drag from this slippage.
In exchange for a much larger, very tangible tax benefit.
And when you look globally, you see how powerful these tax incentives can be. The situation in Ireland, for example, is even more extreme.
Oh, much more. In Ireland, investors in local funds face something called a deemed disposal rule. Every 8 years, they are forced to pay a 41% tax on their unrealized gains.
Wait, on gains they haven't even taken. They're taxing paper profits.
Yes. Imagine being forced to sell a portion of your holdings every 8 years just to pay a 41% tax bill. It's incredibly punitive.
That's a huge disincentive to invest for the long term in your own country's funds.
It is. And as a result, the Irish government is now considering getting rid of that rule. Proponents say it would normalize their investment landscape and maybe stop so much speculative capital from being forced into the property market, for lack of better options. It just proves how much the wrapper, the vehicle design matters.
So boiling this all down, what's the key takeaway for you, the investor listening to this? It seems clear. ETFs have a dominant tax advantage because of this in-kind redemption mechanism.
And for the more active, high turnover funds, they supercharge that advantage using these synchronized heartbeat trades with market makers. The whole structure is engineered for indefinite tax deferral.
A benefit that is obviously most valuable to the highest net worth, most tax-sensitive investors.
Absolutely. The massive capital migration we're seeing suggests that the design of the financial security and the trading plumbing behind it is now just as important as what the fund actually invests in.
Which leaves us with a final provocative thought for you to consider. If the tax benefit from these heartbeat trades averages over 1% a year, but the trade itself introduces these hidden slippage costs, is that tax saving actually subsidizing a kind of performance drag?
Are you trading a transparent tax bill for an opaque tracking error?
Exactly. As these complex ETFs become the norm, should investors just accept that part of their tax alpha is being given back, in a way, to the very market makers who helped create it?
It's the ultimate trade-off between tax efficiency and true investment performance, a question of plumbing versus purity.
Absolutely. That was our deep dive on the heartbeat of ETF tax efficiency. Thanks for tuning in.